am Deidre Quinn, and welcome to Pending and Trending, a podcast that started in real estate and grew into so much more. Here, we talk about the power of building wealth, creating opportunities, and designing a life that lasts for generations. With expert guests and real conversations, my mission is simple: to help you elevate your journey and build the legacy you deserve. Welcome back to Pending and Trending, the show where we go beyond the transaction and into strategies, systems, and the mindset behind real wealth creation. I am your host, Deidre Quinn, and today's conversation is especially timely for anyone interested in multifamily investing, operational excellence, and building long-term financial freedom. Joining me is Ron Kutas, CEO of OneWall Communities, a vertically integrated real estate firm focused on transit and lifestyle-oriented workforce housing across the Northeast and beyond. Ron brings more than 20 years of experience across development, construction, finance, and property management. He's built OneWall around a powerful owner-operator philosophy, aligning operations, expenses, and long-term asset health in a way traditional models often miss. In this episode, we're diving into the extend and pretend era, why workforce housing may be one of the most overlooked wealth-building opportunities right now, what multifamily distress is revealing about today's market, why owner-minded management consistently outperforms, and how technology and AI can actually strengthen community and NOI. If you're an investor, operator, or agent thinking about bigger scale, sustainability, and freedom, this one's for you. Let's jump in. Ron, I'm so happy to be here with you today. Thanks for joining us.
Good morning. Thank you for having me.
Let's jump right in. And you recently posted an article on your website that I found really interesting, and it was about the extend and pretend era. Can you enlighten our listeners about that and tell us a little bit about that?
Sure. So I just got back from NMHC last week, and the last few years, you come out of NMHC and there was a lot of positivity and everybody expecting deal flow to pick up and capital to come back into multifamily. And everybody had this kind of mantra: survive to 25. If you could make it through 25, you'll be all right. And I think that led to a lot of lenders who had loans on their books that were either maturing or started to get in trouble. They decided to just extend or modify loans and just pretend like everything was going to be okay. Everybody was just expecting things to get better once interest rates come down. So I think many operators and many lenders just thought that all the issues related to these troubled loans had to do with interest rates spiking so quickly. And as soon as the Fed would start bringing down interest rates, it would fix the problem and everybody would be okay. So if we could just extend it, we can pretend like there are no problems. I think that 2026 is proving out to be the year where lenders are saying no more. This is the interest rate environment that we're in. We are seeing a real difference between strong and experienced operators and some of the weaker, less experienced operators, those who are well capitalized and those who are not. And I think the lenders are starting to make moves in order to secure their assets because they're starting to get concerned about the value of the asset.
Right. So that really ties into why, it really benefits your organization, right? And can you weigh in on why workforce housing is such a great opportunity to build wealth and invest?
Sure. So yeah, my partners and I started OneWall back technically in 2009, but in 2013, we pivoted towards strictly multifamily. And the reason that we chose workforce housing before it was a cool buzz term was we came out of the great financial crisis in 2008. And we wanted to be recession-proof. That was the most important thing for us. We wanted to make sure that we were preserving capital for our investors. And so we thought that if we go after middle-class properties, middle-class demographic, people who have a strong work ethic and are just looking for a clean and secure place to live, when the economy does well, people move up to those types of properties. And when the economy retracts, people move down from Class A type properties to the Class B type properties. So that's what we started focusing on. We were really focused on transit-oriented housing at first, and then lifestyle choice we started in the Northeast and recently have expanded into the Southeast, where we see a lot of opportunity, especially when that's, I think, the area where the extend and pretend has been most prevalent, at least from my experience. And that's where we're really seeing that kind of shift happen. And so we're getting calls from receivers, from lenders, from distressed operators, asking us to come in and either just take over the management to help improve the asset and the operations, or in some cases outright buy the asset or infuse rescue capital. So that's certainly been very beneficial for us, and we see it as a great opportunity to build wealth. We think that we're at the we're at the start of a new cycle in Class B and Class C properties.
Okay, and let's translate that into what that means from our listeners from an investment possibility.
I think that if you are savvy and paying attention to what's going on in your submarket, you will start seeing signs of assets that are struggling to pay their bills, right? The telltale sign is all of a sudden you start seeing the curb appeal change. Trash is not getting picked up as often. Maybe the grass is not being mowed as often. You start hearing vendors talking about bills being going unpaid. Those are opportunities to start really seeing or researching what's actually happening behind the scenes. You can go, there's plenty of public data on what the loan on that property is. You can see what the basis is that was paid for the property. And that opens up opportunities to try to take advantage either by coming in and providing rescue capital, operational excellence, like I said, with our third-party management, or to just buy the asset. If you're able to make connections with lenders and have a strong relationship with a lender where they trust you and know that you're a strong operator, they may actually give you first look at a deal. So I think this is a really great opportunity for investors to get involved. But the most important thing, if you're a passive investor, is to align yourself with the right operator.
That's great. So that leads into my next question, the right operator. Let's talk about that a little bit. I was looking at your website, and you call yourself owner-minded, having owner-minded management, and you consistently outperform in the market. Can you enlighten us on that and give us some more details on that?
Sure. I think that traditionally, third-party management services have been solely focused on the revenue side of the equation, right? The fee-based service is really incentivizing the growth in revenue without any real reward or motivation to focus on the expense side of the ledger. And so what you've seen happen with third-party management companies is that they just consistently rely on their third-party vendors to provide crucial services within the apartment complex, and therefore they can scale as fast as possible, collect their fees, but at the end of the day, they're not being very mindful about expenses. There's also a disconnect often between the asset management, like the business plan of the asset, and what the third-party manager is tasked with doing. And for example, if you have a business plan that requires renovating 50% of a property. By the way, this is not a business plan that we execute on, the type of business plan that we execute on, but plenty of operators and syndicators have attempted to do this. You're not going to do a great job of emptying out a property where your fee is going to be reduced in half. Right? You're going to want to do it over a longer period of time, whereas the asset manager may have underwritten to do that in 12 months, and they have a bridge loan and they need to get out of that and refinance into a stabilized or a long-term fixed rate loan. If they don't have the right property manager that can actually execute on that, it's going to be very difficult. So I think that on the third-party manager, having an owner-operator mentality means that we're really focused on both the business plan for the asset and the expense management of the asset.
So can you just walk us through a typical situation, or maybe something that you recently had that you took from acquisition and now you are in a position where you're running it and it's profitable?
Yeah. So I'll give you a couple of examples. So we got called in by a equity investor probably back in, I think, May, who had invested in a portfolio of properties and in Texas. And we were asked to come in and replace both the asset manager and the property manager and really act on the owner's behalf as an owner's rep almost, right? You're used to hearing owner's rep in construction, but the reality is this was a very well-capitalized group that invested in this portfolio, and they were not getting good asset management or property management, and they wanted to align it all together. So they called us, we came in, we took over a few properties, some of which were 50% occupied, with no real plan or path to stabilization. The property management company was afraid to ask for capital infusion, and so they were just pretending. Payables were not growing. They were not putting invoices in a timely fashion because they were concerned about getting fired, instead of just letting their equity or the owner know exactly what was happening. So we came in, it took us about 2 months to really assess the situation, put together a new business plan for each one of the assets, put together a capital infusion schedule in order to turn the asset around, and we've been doing that and have been pretty successful. So that's one story. Another one is we got a call from a lender who had a troubled asset. The operator had already lost a couple of their properties with the same lender, and they were on a path to lose another one. And this lender is very sophisticated and understood that if they wait for the foreclosure to happen, there is a huge value reduction during that time frame. And so they had a cooperative operator. They asked us to come in and manage the asset before it gets into more trouble so we could help just stabilize things. And we ended up being the buyer on it. So it helped us because we understood the asset better than anybody else. We also helped the lender and the operator because they got the best value that they could have given the situation.
Now, is there a period of time that you hold these, or do you look to sell them at a certain point? What does that look like?
It's funny. When I first started in the business, I said, this is wealth creation. I'm never selling, right? But you realize as businesses mature, different things happen, and you do need capital events to keep growing, to keep things going. While we underwrite every deal to either a 5 or 7 year hold when we're buying something, simply because that's what the market requires so that you can calculate your IRRs and equity multiples and so on and so forth, we tend to think of the property as a long-term hold, and so we will invest capital into the property as if we're going to hold it forever, but we'll let the market dictate. And if there is a point in time that my acquisitions team will look at our financials and underwrite the deal lower than what the market will tell us, it's usually time to sell.
Very good. Very good. Now, with the, we have a lot of AI that is coming into, and every conversation has something to do with AI, and every business is being changed somewhat by AI. So how is that? How are you able to use that to your advantage? How is it helping you? And what does that look like?
So we've taken AI early on. I think right before ChatGPT became like that December of whatever it was, 22, 23. I don't even remember what year it was. I brought in a consultant who specialized in AI to come speak to our leadership team to understand how it can impact real estate. And I remember walking out of our leadership team meeting where this guy presented, and everybody was just like, nobody understood what he was talking about. And everybody was just like, okay, like futuristic stuff, whatever. And then I think it was a month or two later, ChatGPT became the fastest growing tech app, and the rest is history. So we've embraced it. We use it all the time. I encourage many of our staff members to use an LLM as a tool for all different reasons, whether it's just writing or analysis. But we've actually built it into our workflows. Excuse me, I'll give you a couple of quick examples. We developed our own proprietary reporting tool that takes all of our data on a given asset from the various different point solutions that we have. It uses AI to analyze the data and then predict trends that are coming down the pipe, and then present it in a really user-friendly report, dashboard really, that our owners receive, every person involved in that property, whether it's a leasing consultant, a community manager, a maintenance tech, they all get their own kind of version of the things that they should be looking out for. And it's turned what used to take about 2 weeks to close the books until reporting comes out. It's taken that down to 6 days. And instead of a 16-page PDF that takes a half hour to review, it's a really beautiful link that in 5 minutes you can get a really good understanding of what happened at the property, but more importantly, what's coming.
Isn't it crazy? How do we ever live without it? I almost don't even know. In some ways, it's been such a short time since we've been using it for so many things. And I'm like, oh my goodness, what did I do before this?
I know. I had this vision for changing the way we do our reporting 3 years ago. And I spoke to a bunch of developers to try to figure out how to get it done. And I think at the time I got a quote that it would cost about $300,000 to do what I want, to code what I wanted to do. And it would take about 6 months. And with AI, we did it in 6 weeks, and I think it's cost us about maybe $6,000.
Unbelievable. Unbelievable. It's just amazing. And that just goes to show you that we can really use it to enhance everything that we do in so many different ways. Ron, if I was a listener right now, the one thing that I would want to know is, what is the range to get involved? And maybe the minimum range and the average range as far as getting involved. What does a return on investment look like? And what's the timing on that return?
Yeah, when we syndicate our deals, minimum investment is $50,000. And we have investors that invest up to millions. A typical investment holding period is, like I said, 3 to 5 years, depending on the deal. And we do raise our equity on a deal by deal basis. We target 15 to 18% IRR for our investors. And we're notorious to being conservative. We are very much of the mindset that you underpromise and overdeliver. So we don't really use any aggressive assumptions. It's all about improving operations at the property and not relying on cap rate compression or absurd rent growth. So most of our deals do around 7% cash on cash, and we do structure a waterfall with a promote. And I would say that the deals that we're doing now, because they are distressed assets mostly, and they are deeper value add, there's usually a 2-year period of no cash on cash return, but a higher multiple in a shorter period of time. So those are going to be 2 to 3 years, but it's going to be deal by deal specific. And yeah, that's generally been the way that our deals have operated.
That's great. So how can our listeners find you? Is your website, OneWall Communities, the best place to start?
Yeah, our website is onewallcommunities.com or owcommunities.com. Both go to the same place. And there's a form there if you want to get in touch, and somebody on our team will reach out to you. And we're all over LinkedIn and happy to have a conversation with anybody in the industry.
That's great. That's great. Thank you so much for sharing with us today. Do you have one last thing that you'd like to add before we close out?
Make sure you choose the right operator.
Ron, this has been such a valuable conversation. Thank you for breaking down what owner-operator thinking really looks like in practice, and for sharing how disciplined operations, aligned incentives, and smart systems create real financial freedom, not just more doors. For those listening, if today's episode got you thinking differently about multifamily workforce housing or how operational excellence drive long-term wealth, I highly encourage you to connect with Ron and explore the work happening at OneWall Communities, especially as they expand into third-party management and institutional partnerships. Thanks to our listeners. Thank you, as always, for spending your time with us here on Pending and Trending. If you found value in today's episode, be sure to subscribe, share it with someone in your network, and let us know what resonated most. Until next time, keep thinking bigger, building smarter, and creating wealth with intention. I'm Deidre Quinn, and this is Pending and Trending. Thanks for tuning in to Pending and Trending. Remember, generational wealth doesn't happen by accident, it happens by action. If you like today's episode, share it with a friend, subscribe, and let's keep elevating your journey together.